Hi, welcome. We're going to talk about financial statements, reading and understanding financial statements. So what are financial statements? Well, financial statements are the records of financial activities and positions of a business or a person. You can make personal financial statements, and a lot of times you have to do that and present them to the bank if you're going for a mortgage or a car loan or any type of interactions with your bank like that. It's good to have personal financial statements where you have what your income is and what assets you have and all those kind of things, what liabilities you have, what debt do you owe. So financial statements are the product of accounting. It's basically what accounting does. Accounting, the end product of accounting, keeping all the records of a company's activities or a person's activities, ends up in reporting in these financial statements, which are templates basically. They're three documents basically: an income statement, a balance sheet, and a cash flow statement. We'll go through those in a minute. But those three documents constitute the financial statements, and they're templates, so they're structured, in manner and form so that you can understand them quickly. They're standardized, so they're easy to understand. So every company has to report their financials in the same type of standardized templates. And so why would you do that? Well, it's to report. So for a company, the leaders and the managers and the board of directors, they all need to know what's the company's status, what's the position of the company, how is it performing relative to other companies, and how is it performing relative to itself historically. Is it growing or is it declining? What things are doing well, what things are doing poorly? That's what these financial statements allow the company to understand how they're doing. And it's also good, they're used for investors. Do we want to invest in this company? Now, the companies that are on the American Stock Exchange, they report to the Securities and Exchange Commission a document each year called a 10-K. And that's an annual report of their financial statements with a bunch of other, dialogue and descriptions of their business and management's discussion and analysis of everything. But the core, the meat and potatoes of it, are the financial statements. So for investors in public markets, they're looking for what are the financial statements? What does the company look like? For investors, say venture capitalists or angel investors, they want to see financial statements that have been produced by a third party, arm's length kind of thing, so that they can see what they're investing in, what they could potentially invest in, even on the venture capital side, right? So for any type of investments, you want to look at financial statements. You want to know how to read them. And it's also good for your bankers, like I said, for personal people, or for a business, you're going to your bank to figure out, can I get a loan? Can I get a line of credit? Well, they want to see your financial statements. The credit analysis is based on financial statements. And also you report these to the government, right? For tax reasons and other regulatory reasons, the government's going to want to know what are your financial positions. So now that we've talked about the importance of these financial statements and their relevancy and why you need to know about them, and so you can use them and you can read and understand them, now we're going to talk about what the heck are they, right? Okay, so let me erase this quickly and we'll talk about, in general terms, the financial statements. And then the lectures after that, this will go into each of these financial statements individually and even into the different line items of them, so we can really get a quick understanding of them. So what are they? I'm going to start with the first. There's three of them. And I'm going to start with the first one, is the one that intuitively you know about, because that's how you operate, that's how we operate our lives, right? And that's called the income statement. Now, the income statement is revenue minus expenses equals net income, right? Now think about that. That's how we operate our life. We get our revenue, say it's our salary from our company, from our job or whatever it is, the tips if we're, wait staff or whatever kind of thing, that revenue, and then we have our expenses, right? And our expenses could be our rent or our mortgage or our car payment or our food and groceries, our clothing. All of those things are expense lines, right? You subtract those expense lines from your revenue, and what's left over is your net income, or called profit, things like that. So that's the one that you know about, because that's how we do every month. We do that with our life, right? With our checking book. You get the money in, the money goes out, and hopefully there's a little left over and you're not putting a deficit on your credit card or something each month. That's a real recipe for financial disaster. So the next one is the balance sheet. And the balance sheet is a little more conceptual, but you can understand. A balance sheet is what do you have? Assets and liabilities and equity, right? This is the balance sheet. So now, and how it works is that the liabilities, the debt that a company or a person takes on, and the equity, the amount that you put of a down payment or what shareholders' equity in a company, those two things, right, they fund buying assets. And in a company, you're trying to buy income producing assets, productive assets that are going to make money for the company, right? Same thing in our life, we should do that too, right? We're going to buy investments, or we're going to buy things that help us to make money. If we're content creators or something like that, or doing a side hustle, we might buy a subscription to a certain blog or a Canva, so that we can do something to do our graphics work or whatever. Those type of things are considered income producing assets. They help us to make money. And so that's what a balance sheet is. And an easy way to remember this, because it's hard, and these two things have to balance. That's why they call it a balance sheet. The assets have to equal the liabilities plus the equity, right? This side has to balance with this side. And this is called the accounting equation, right? Another hint about accounting in this, right? But that's what it is. Assets equal liabilities plus equity. And so the way to think about this is with a mortgage with a house, right? With a house buying. Well, when you buy a house, you're basically doing this whole transaction, right? The liability is the mortgage. That's the debt, right? And in order to get the debt, you have to put down a down payment. The down payment is the equity, right? And so the mortgage plus the down payment are what you use to purchase the house, right? And how do you value the house? Well, when you first buy it, it's a negotiated transaction, right? The person says, I want X for it, and you say, you'll give Y, and then you sort of meet maybe somewhere in the middle, right? And that's the value of the asset. Well, if there's no transaction like that takes place, say later on, 20 years later, you want to know what the value of that asset is, your house, you get an appraisal, right? An appraisal's done, and they measure the comparable sales that have been done in the neighborhood in the recent times, and how much it would cost to replace the house by rebuilding it, and that's the value of the house. Now, as the equity goes up over time, as you pay down the mortgage, the liability goes down and the equity goes up. If the house increases dramatically in price, well, where does all that extra asset value go to? Well, it flows to the equity side, right? That's the appreciation that people like. If the house goes way down in price, or the asset, then what happens? That diminishes the equity, and at some point it wipes out the equity as this price goes down, and then all you're left with is the liability. And that's what they call when an asset is underwater, when it's no longer functioning well. And that's what happens in banking crises, right? They have all these assets on their books. Suddenly they have to mark these assets lower, and it wipes out the bank's equity, and they're just left with the debt, and suddenly the banks become insolvent. That's the scary part with a bank, with the banking crisis that happened like in 2008. So now we know these two, the income statement and the balance sheet, and they're really the crux ones that you need to know, and they're intuitively easy to understand. The balance sheet is basically a snapshot, right, in time, and the income statement is something that happens over time. How much revenue did you make in a month or a year or whatever, or a quarter type of thing. The last one is called the cash flow statement. And the cash flow statement is, I'll write it all out so we see it, cash flow, right? The cash flow statement. And what the cash flow statement does is basically reconcile between the income statement and the balance sheet, because some of the things in the income statement may be transactions that are non-cash, and we'll talk about that in more detail. And so there's things that have to be adjusted. So you say, well, how much cash do I actually have in the bank? And the cash flow statement basically takes the bottom line of the income statement, net income, right? Starts with that. And then what it does is it plus or minus adds back in operations. There's 3 sections to it. Operations section adds back or takes away non-cash transactions that influence the net income, the income statement. And then it takes investing activities. Say if you buy new equipment for your business or something, trucks or machines or whatever it's going to be, and you want to put those on your balance sheet as an asset, well then that money actually comes out of in the cash flow statement. It doesn't show up in expenses, right? And then financing is the last thing. And financing is, say if you raise money from selling debt or selling some stock, like a stock market, initial public offering or something like that, that money comes in to the company into the financing section, or goes out as you pay off the debt, say, or something. And so then this is another place where we adjust the numbers that come from the income statement. And at the bottom here, boom, that's how much cash you have. And that cash number has to add up to the top asset, here, which is cash on your balance sheet. And we'll talk about all this in much more detail. But these are the 3 financial statements, and those are their 3 functionings. And what I wanted to show you there in basic terms is the 3 financial statements interconnect and money flows between them. And at the end of the day, that's the most important part of a business. That's how we keep score, is how much money comes in, what it goes to pay, and how much is left over, and what we use that money that's left over for. That's why the financial statements are so important. So next we'll get into these things in more detail. We'll start with the income statement and then go through the other 2. And I'll see you in the next lecture.